Hello friends, in the next few minutes, I am going to take you through the key events of the recent past and Kotak Mutual Fund's view on equity markets. Markets in September witnessed significant volatility, almost all of it emanating from global developments. The first half of September saw markets rising, continuing the trajectory that they had seen in July and August. At the midpoint of the month, small cap index was up 4%, mid caps was up 3% and large caps up by 2%. However, post the US Federal Reserve meeting, where they noted the persistence of high interest rates in US to combat inflation, markets corrected quite significantly. Europe continues to be beset with problems emanating from geopolitical developments. With gas flowing through the pipelines from Russia to Europe impacted, the energy situation in Europe and consequently economic activity remains very vulnerable. UK elected a new Prime Minister whose team presented a mini budget whose main highlights was tax cuts and stimulating the economy with even more debt. Both the currency and UK yields didn't take it nicely and corrected significantly in light of these developments. These events further led to liquidity moving to the safer haven of the US dollar. Dollar index DXY saw a significant sharp up move this month, further impacting the risk sentiment. With Indian equities and the Indian rupee having outperformed significantly over the last 3 months as well as during calendar year of 2022, this global risk off saw FII booking some profits and selling equities. The INR also weakened, especially against the US dollar, even as it has strengthened against most other currencies globally in recent times. However, while there is a near-term simmering of risk sentiment, there are medium-term positives emerging for India. One, global commodity prices clearly are correcting in light of the likely global weakness and potential recessionary outlook. With India as a large importer, this fall in global commodities, especially crude and other energy prices, augurs very well. Two, European reliance on energy from Russia is unlikely to get resolved in the near term. Any build out, therefore, of alternate energy options will take 2 to 3 years at a minimum. With energy being a key input to manufacturing, European facilities risk being competitively unviable globally. Historically, most of European companies' capex was either to Eastern Europe or to China, and both these regions are likely to take a back foot for now. Is it therefore possible that Indian manufacturing sees an increased offtake that the European factories vacate at the margin? Only time will tell, but it does appear that Indian manufacturing companies are in good shape, having reduced their debt and investing in capacities for the future. 3. US as an economy is short of manpower as recent employment trends indicate, and while demand is likely to fall as large hikes on interest rate pass on to the real economy, it does open the potential for greater offshoring to Indian companies. And lastly, the series of reforms initiated over the last few years, GST, RERA, tax compliance, all has meant that the domestic cycle is much better shape in India compared to the rest of the world. All this doesn't mean that we will not get impacted by global factors, especially in the near term, but it is important to keep the bigger picture in mind while evaluating investment choices, and in that context, India does seem very favorably placed. Clearly, the Indian outperformance this year, where we have fallen one of the least in local currency terms, captures this growing sentiment. Valuations thus are above longer term 10-year averages in India, even as most other markets are significantly below their last 10-year average valuations. While global factors can see return of FII selling, domestic investors' allocation through monthly SIP flows, EPFO allocations to equities, etc., does provide a reasonable cushion to absorb some of these outflows. For sure, global risks have gone up, and while the direct impact on Indian economy is limited, indirectly India will definitely get impacted with a higher global cost of capital. However, these risks are transient and unlikely to impact the longer term competitiveness of Indian companies. If any, Indian companies can benefit in the long run with more outsourcing and more value chains in manufacturing wanting to move to stable countries like India. Given that ups and downs are part and parcel of asset class like equities, it is only natural to expect higher volatility in the times ahead. However, rather than obsessing over the fear of fall, we would encourage investors to use such opportunities to increase allocation to equities, especially if one is underweight this asset class, as is the case for majority of Indians. Given this, a disciplined asset allocation with a focus on longer term goals is imperative, and equities continue to be an important avenue to fulfill these obligations. In case valuations do significantly correct, we do advise investors to increase their allocations to equities in a systematic and disciplined manner. Be patient investors, and do remember, time in the market is more important than timing the markets. Thank you and stay safe.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.